Good afternoon, everyone. Today is Friday. It's the 12th of April, 2013, and this is Brian Shannon speaking from uptrends.net. We had a pretty wild week, and the market finished with gains for the equities and the equity ETFs, that is. The SPY up 2.5%, NASDAQ up 3%, Russell 2000, which was giving us concern last week as it broke below 93, did recover 2% and got back above that level. So we had broad buying of equities. The gold got hammered here today, especially down 4.7%, and now down 6% for the month and 11% year to date. Let's take a look at the charts and see how it shook out. If you recall, last week we were talking about the important level for the S&P 500 to continue to hold above was at 153.50, and that because we were above a rising 50-day moving average, that we were going to continue to give the benefit of the doubt to the buyers. But it seemed as though the market would need some time to correct here. Well, the market did not correct through time. Instead, it just continued to rally from the gap lower 1 week ago for after the jobs report numbers. So we saw continued strength up to today. We had seen this real nice pattern of higher highs and higher lows, and we broke that today and had a little bit of selling. But obviously for the week, we had a great week for equities. And now I think that the key level for next week that we'll want to see hold is probably down near about 156.5 to 150. Well, close to 156.90 to 157.10. That's going to be the key level. We're a little bit extended here, and some pullback wouldn't be a bad thing. I'm sure people will call it the end if once again. But again, listen to the message of the market. As long as we remain above key levels of support, we give the benefit of the doubt to the buyers because we have a rising 50-day moving average. We get cautious when we have these big breaks with what seems like important news, but the market continues to climb the wall of worry and tell us that all this news that is supposedly bearish for the market, Korean nukes, Cyprus, jobs report, all that, the market simply does not care right now. Momentum is stronger than that. The market climbs the wall of worry. So we remain in an uptrend, and our job as prudent money managers and traders is to manage risk. Managing risk alone doesn't make any money, of course. What we have to do is position ourselves in the right things at the right times as well. Here's just for those who are interested, a chart of the year-to-date volume-weighted average price. And when we kind of clean it up and just take everything off, you can see the simplicity of resistance becoming support. And we had a little shakeout earlier this year, mid-February in the SPY. We recovered quickly, and we just continue to move higher. So the benefit of the doubt continues to go to the bulls. Manage risk. That's our job. The NASDAQ really kind of surprised me more than anything here. That is that, we were talking about this channel that the NASDAQ has been in, and basically, kind of goes more like this. But this has been the channel for the NASDAQ, and it's been really choppy. We took a look at that volume weighted average price alone, moving average alone with price last week, and emphasized how choppy it's been in here. But we did see this market recover very nicely, and here's the thing is now that this market is starting to look bulletproof, as if nothing matters. Of course, at some point, we can point to the headlines and say, see, that's why the market is down. It's because of Russia, because of whatever the news headline of the day is. We have to be more interested in the reaction than the actual headline in our opinion of it. But the NASDAQ, broke some important support here and recovered nicely back up through that 68.50. We're talking about, will this 68.50 become the resistance? I'm sorry, wrong time frame there. Will 68.50 now become resistance? That's what we were talking about as we headed into this week. Well, of course, we ramped up through there and just continued, I think, to squeeze some short sellers who got a little bit cocky here as the market gapped down on so-called bad news. Only price pays. I emphasize it over and over for a very specific reason. It's because this is what represents the truth in the market. You can argue with it all you want about the logic of the move. and that sort of thing. But really, if you're here to make money, you have to listen to price, not to the headlines. The Russell 2000, let's talk about that, because again, here, this market, we were talking about it and saying we saw this break of an important level at 93 to 93 and a quarter, and the thought was that it had the potential to act as resistance, pull back, and then we'd see how the market handled it from there. Well, the market didn't even pull back from there, really. It just blasted right up through it and caught a lot of short sellers off guard, I think. And now this market, if we look at it, we're above a rising 5-day moving average. This prior support was tested in here today, if we look at the shorter term time frame, and that's right wherever rising 5-day moving average as well. So I think next week that this 93 level is going to go back to being an important level. That's where we have a 10-day moving average as well, and it remains innocent till proven guilty with a rising 50-day moving average. I talk a lot about the direction of the 50-day moving average, and it's more important to see how the market reacts, not just to get bearish after it closes a couple days below it, but what's the direction of the 50-day moving average. And here it's clearly higher. We spoke about, a couple weeks ago we spoke about Visa and the direction of the 50-day moving average. We spoke about Apple, which we'll talk about further in here, and the direction of the 50-day moving average. And we've been talking about gold and the direction of the 50-day moving average. So let's get back on focus here and go back to the Russell 2000 for a moment. So we'll want to see 92.75 to 93. That's what we want to see hold next week. And it does seem, again, the market seems extended here. It's if we look at the year-to-date price, we had seen the market come down to the volume-weighted average price, the 50% retracement, and that trend line, and really ramped higher from there. So now perhaps this market needs time to recover, and we'll say the same thing basically we said about the S&P 500 last week, that it seems like maybe it's a little bit extended and it needs to correct through time, but we give the benefit of the doubt to the buyers, and news and surprises reactions to news and surprises tend to follow the direction of the trend, which is clearly higher in all these markets. The semiconductors really staged an impressive rally. They looked like they had the potential for this head and shoulders pattern. We were talking about that, and that if this neckline acted as resistance, then perhaps it would continue lower. So we came in not saying that 34.5 would be resistance, but questioning whether this range, 34.25 to 34.60, would in fact become resistance. That if it did, then it stood the chance of a further decline. Instead, it ripped right up through there, and we've got this market really recovering once again. There was a little bit of resistance in here recently at 35.60-ish, and if it can break through that, then these semiconductors looks like they will have recovered and perhaps are heading towards the highs from this year and 2012 as well. So the buyers remain in control of all these markets. We saw it in the financials again too. Financials for the week were up 2.4%. They're up 12.7% year to date. The financials are, and this is when we have economic crises, throughout the globe that people will continue to tell you about. We saw a test last week of the rising 50-day moving average after breaking that important support at 1805, and we came down to the band where we expected support. We found support there, but I certainly didn't expect that it would just run right back up through that 1805. In fact, we spoke about the possibility of, if it found resistance there, perhaps shorter term traders would be able to find a short opportunity, but they're fighting the direction of the primary trend with the 50-day moving average still heading higher. So this market also, if you look at it since the beginning of let's take a look at a 130-minute time frame. We've seen we've seen some of these pullbacks that break this support in the short term, but then the market comes roaring back right after that. So it's not the break of support that matters so much, but does that support then act as resistance and then bring about a further decline? Because that's how reversals occur. Obviously, we're not seeing any reversals of this uptrend, but that's how it would have occurred had we been in a position maybe where the 50-day moving average was flattened out. Instead, we continue to hit multi-year highs, and we're still heading for that $20 level, it looks like. We spoke about gold, and I specifically said that it's last Friday that clearly sellers were still in control of gold. Last week we got a little bit of a bounce in gold, but I was talking about it seemed very likely that we would see a test of these levels down near 148. And now what you see in gold, really, if you look at a longer term chart, this is a monthly time frame. We had a real nice pattern of higher highs and higher lows, classic stage 2 uptrend. Then we saw distribution, and now we're seeing a break of important support. If this market can't really get back above 150, and here's going to be the band of resistance, basically 148 to 150, then I think gold could be headed for really even a multi-year decline from here. So gold is clearly still in a downtrend. You can argue with the logic of it all you want. You can say that this is a flight to safety. Obviously, it's not a flight to safety. In fact, our bonds are the flight to safety. Our bonds last week had a great week on that unemployment number, and they continued to move higher here. Well, they were down slightly for the week, but certainly most people coming into this year did not expect that bonds would in fact be higher. Yields obviously being lower on this 20-year blended ETF, but the path of least resistance in the bonds is still a little bit uncertain here with this longer term chart. But it seems as though maybe the tide has changed, that this pullback has sustained itself, and now if what would really be good to see is that if it can kind of digest these gains and then push up towards this next level, which would obviously bring interest rates down further once again. Let's talk about Apple, because I think I mentioned Apple last week that I was going to talk about it, but didn't for some reason. Anyways, Apple is still clearly in a downtrend. We spoke about it hitting the volume weighted average price year to date a couple weeks ago as it bounced within the primary downtrend, and that's the third time or so that volume weighted average price year to date had acted as resistance. Now we've still got a declining 10, 20, and 50-day moving average, and we had an anemic bounce here. This bounce occurred on anemic volume, and we have to be aware of all these companies that earnings reports are due out soon. So be aware of that. But it still appears as though Apple could be headed down towards 400, 390, somewhere in there. The point is, it's still in a downtrend. We have what's looking maybe like a possibility to hold this prior area in here of significance, which is basically 427 to 428. This was support, then turned into resistance. We've got a rising 5-day moving average. This is really, if we're going to get a bounce that amounts to much of anything, and maybe we get another test of that 50-day moving average up near 450, it's going to have to at least do some work on this 438 area where we found resistance this week. So Apple still cannot be trusted on the long side. The volume weighted average price for the week right in here, and we've got a little bit of short-term support in here at 431 that has the potential to act as resistance. By the way, if you look at alphatrends.net, it's changed. It's on a different server. It's got a different look. We're still working some things out, but go to alphatrends.net and click on blog. That's this page you have right here, and the recording size is a little bit small. So anyways, go to alphatrends.net, click that blog. Yesterday I had posted this kind of what's dramatic headline, I suppose. I was trying to get attention. Will Tesla shorts get squeezed to $100 a share? I was talking about the chart, and then if you click this continue reading, and by the way, the sound issues, I'm going to tell you again, the audio that goes up and down, that is something that's going on in YouTube. It is not part of the recording. If you go to Alpha Trends and watch the video, you will not have that same audio issue. Anyways, I was talking about Tesla, and I'm going to talk about Google in a moment here too. The Tesla has a very large short position. In fact, if we take a look at it here, we can see I posted this on Alpha Trends. As of March 28th, there were 31 million shares sold short that hadn't been covered. Well, the stock gapped higher on the 1st of April, and since the 1st of April, we can look at the volume weighted average price of basically of this of this move, and I'm just going to do it quickly with the line because I didn't have the moving average, but it's at about 43.20, and you can see here that it gapped up, it pulled back, it found a little resistance in here and rallied up to that volume weighted average price since the gap, and that found support in here as well today. Now these shorts, if you think about it, every one of those shorts as of March 28th had positioned themselves before March 28th, and you can see that, well, March 28th, the highest they could have possibly shorted it really is about $40 a share, because this is an all-time high for the stock. So that tells me there's 31 million shares of potential demand for this stock, and when you look at the average volume for it based on last month's numbers of 1.3 million shares, the average daily volume was 1.3 million shares a day. Well, it would take them 22.9 days of their buying alone to cover this stock. So it has the potential for a large short squeeze. Coming up with a price target of 100 is just foolish. I did that to get attention towards it because I was told that that's what I need to do to make my headlines sexier. But there's a well thought out article. Go to Alpha Trends and take a look at that. Let's talk about Google real quick, because Google here, I wanted to point out that, we still have a rising 50-day moving average, but the stock has been pulling back, and we have found some support, it looks like, at this rising trend line from the lows of November of last year. And what I had drawn in here as well is this Fibonacci off of the low to this year's high, and we get a 38.2% retracement right around in this 765 area, which was prior resistance as well. So perhaps we continue down towards 765. Let's just clean that up. But we have the volume weighted average price year to date, which was tested this week. But you can see here on the near term, we do still have some pressure on the stock. So I think that it's going to need to at least get above this 795-ish area before you can really look at Google and say it's worth a buy. We've got, this resistance became support. Now, if it can break a higher high here with a stop just below this higher low, then I think that Apple could continue to bounce nicely. Perhaps up towards 815, 820, and then who knows what's after that. Anyways, thanks for tuning in. I know this one went a little bit longer than usual, but I talked about more things. So anyways, enjoy your weekend, and take a look at alphatrends.net, the new website. Also, you know what? I meant to mention this. On Alpha Trends, I've got where the heck was it? If you go to the home page, that you can sign up for an article I wrote about swing trading. Just put your name in here, and then I will email you these videos at the end of each week as well. Take care. Thanks.